Good day, students. I will be covering this case study as part of session 3. This case study is quite a nice one to sort of go through the different parts of your income statement and balance sheet and what you then need to extract in order to do either the capital budget or the valuation of the company. So let's go through this example and get started. It says you have developed a chain of 10 cyber cafes near university campuses like Wits, UCT, UJ Rhodes, and Stellenbosch. Your business concept is to serve Java to the building revolutionaries, the caviar communists, and limousine liberals that live in the vanguards of social change. Okay, that first paragraph is quite intense. But let's go through the second paragraph. It says, in spite of the fact that money is the root of all evil, you are highly profitable and you have decided to expand your operations by opening new cafes. Okay, so the biggest thing with this case study is we're now trying to assess what would be the valuation of this company, given that it's now deciding to open new cafes, and now we want to forecast what would be the cash flows when we've added these additional cafes. Okay, so the information that is required, I'm going to go further down, is basically from paragraph 3 and onwards. Okay, it says you plan to add another 3 cafes each year for the next 4 years. So there'll be 22 cafes in total. You lease the space for each cafe for 180,000 Rand. And you will be spending 900,000 Rand to build each cafe to your specifications. Your construction is on schedule, and you'll have 13 cafes fully operational by the end of the fiscal year. Okay, so you're building an extra 3 cafes per year. You had already started off at this point with 10 cafes, so that is sort of based on your history. Going forward, we want to add 3 new cafes per year. Okay, so if you want to set up here in your Excel, if you look at here how we've set it up on the right, what we've done is we've added here the number of cafes. So we're going to be starting off with 10 cafes in 2017. We've added an additional 3 new cafes for that period. We then go to 16, 19, and we then end off at 22, which is what they said, that there will be 22 cafes in total. In that last financial year, given that there will be 22 cafes in total, there are no new stores that are opened up. Okay, so this here at the bottom of just highlights the number of cafes that are opened and highlights the total number of cafes that are in operations in each year. If we read further, it says when a cafe opens, the 900,000 expenditure is then depreciated at 10% per year. So what I want to try to do here is set up all the relevant information here in the Excel here at the top. So we started off here with the depreciation. We've got the depreciation noted there, that each depreciation of the 900,000 cafe that's been added on will be depreciated at 10% per annum. It says, in addition, each cafe has 25 days of inventories on hand and can get 45 days credit terms with suppliers. You estimate that every cafe you open adds additional 300,000 in expenses. Okay, so we've got the fit out cost of each cafe will cost us 900,000. We've also noted here the additional 300,000 in additional SG&A expenses. So I've noted those 2 costs. And then I've also put down, besides the 10% depreciation, I've put down what they say the 25 days of inventory days and the 45 creditors days that are coming through also in the information. So this is just a summary of all the information we've noted down as and when we read each paragraph to make sure we've taken into account everything that needs to be added. Okay, if we carry on reading, it says it takes 12 months to build out each cafe, during which you incur lease expenses. So we start incurring the lease expense, even though the construction will be happening during that year. So we need to take into consideration the rental cost of each cafe being 180,000 whilst the cafe is still being built. So we've noted here that the lease costs while we wait is a rental cost of 180,000 that needs to be paid. And we expect to incur these lease expenses even whilst the cafes are being built. So even though you're not earning revenue yet on the cafes, you are spending 180,000 upfront whilst you build those cafes. Okay, it says once now the store or the cafe opens, revenues will flow at an annual rate of 1 million per cafe. Okay, this is then going to become quite handy when you're doing here at the bottom. We've got the total number of cafes, as you've added 13, 16, 19. What's quite nice is if you've done this and set it up quite nice here in your Excel, all you have to do is then multiply the revenue per cafe multiplied by the total number of cafes that are then operational each year. Okay, so 1 million per cafe of revenue. They've given you also the gross margin of 70%. So we're going to be earning a gross profit of 70%. We'll note the 70% gross profit margin here as part of the information that we've received. The 1 million revenue together with the 70%. So we can highlight that. That's formed part of your question. And then it says, you maintain a cash balance of 2% of sales. So I want to note that down. Cash here will be 2% of sales. Also noted that here in the information that's been provided. And some business accounts pay on 30 days. Okay. Assume that business accounts make up 20% of current sales. Okay. So your credit sales portion, the people that have 30 days to pay, are 20% of your sales, and you are giving them a credit facility of 30 days to pay you off. Okay, so we've got the credit sales portion and we've got the number of days they will take to then pay us, which is 30 days. Okay, also highlighting that as that is also information that we can be using. Okay. Assume that business accounts make up 20% of cafe sales. Okay, we've already noted that. Makes up 20% of your sales. And it says the income tax rate that we want to note down is 28%. You have a line of credit at a bank that allows you to borrow up to 10 million at an interest rate of 12%. You paid a special dividend on 31 December 2017, but the bank will not allow you to pay dividends if your line of credit is drawn down. Okay, so we've got a facility to borrow up to 10 million. We haven't drawn down on this facility. If we then need this facility, we will then not be able to pay dividends. So we can either pay dividends from our retained earnings, depending on how much profits we make in the period. But if we then need an overdraft facility, no dividends will then be paid. Okay, so the last bit of information here that you're given is, should you then withdraw and use up this overdraft facility, you will then need to pay 12% interest. And then they've also had given you in that paragraph the 28% tax rate. So now we've actually drawn up all our information that we need. And if you'll notice here, we've set up quite nicely all the information we'll be using for our income statement and for our balance sheet. Okay, so just to sum up here, the case study that we're looking at, they're telling you that you've got 10 stores up front. You want to build an additional 3 stores per year. They've given you what the additional rental will be, what the additional selling, general and administrative costs will be, your SG&A expenses. They've also given you the revenue and gross profit margin, which we've noted down. And then for our working capital, which is your debtors, your creditors, and your inventory. They've given you the amount of days in the entire year that you then need to keep as your working capital balance. Okay, so what we're going to be doing now in this video is I'm going to be setting up the income statement and the balance sheet and show you how it's calculating using all this information. You'll notice in the information that's been then provided of what's actually happened as a result of the 10 stores. They've given you here an income statement for 2017 for your 10 stores. All you have to do is copy that across into 2017. That has been provided. And then for 2016 and 17, they've also provided you a balance sheet here. And if you look into the balance sheet, we had retained earnings of 2330 and retained earnings of 1425. So currently, as it stands, your cafes are earning a bit of money and profits for you. You're earning around a profit of around 1 million, let's say, just for these 10 stores. So now going onwards from 2018, we're going to add the 3 additional stores, 2019, 6 stores, 2021, and so forth. Okay, so for your income statement purposes, for accounting, all we're going to be doing is factoring in the additional revenue from these stores that we are earning, which they said is 1 million per cafe. We're also going to be taking into account your gross profit margin, which is at 70%. You're going to be taking into account your selling, general, and administrative expenses of 300,000 per cafe. And then we've got our depreciation that needs to come through. Remember that the fit out cost or your capex that you're spending per cafe is 900,000. That then needs to start getting depreciated over time, which then will be factored into your income statement. Okay, let's have a look at our income statement. The income statement, the first thing we're going to do is when we've copied across the 10 million here in 2017, this 2017 income statement was provided. All right. So all you did here was copy across the exact profit after tax to get you to that 1,008,000. And now from 2018 going forward, we're going to take into consideration the extra stores. Okay, remember what they said in the question, that even though we've added 3 extra stores, these extra stores are not getting revenue that year. You are paying, yes, the rental, because you are constructing those stores during that 2018 period, but the revenue will only start kicking in only in 2019. So you'll notice here for 2018, your income statement, the revenue is still only 10 million, even though we are constructing 3 additional stores during that period. Okay, so we've got the revenue still remaining the same at 10 million because those 3 additional stores are still being constructed. They haven't started bringing in revenue for us, even though we're spending on the rental of each store. So remember, we're paying 180,000 per cafe for each new store, and we have to rent it out whilst we are constructing. So you'll notice here in your rentals, here, when you get to the 2340, what we're going to be doing here is calculating the number of cafes. So you're going to pull through the 13, and you are paying a rental expense of 180,000 per cafe. You've got 13 cafes that year that you are constructing, and you have to pay a full 180,000 in SG&A expenses for all 13 stores, even the ones that are not bringing in revenue yet. Okay, so we've got your 10 million revenue, your 3 million costs, exactly the same as 2017, your 70% gross profit margin, still at 70%. And now what we've brought in is the extra rental of 180,000 per cafe. Okay, in terms of selling, general, and administrative expenses, it says you estimate that they will bring in an extra 300,000 selling, general, and admin expenses per year. And it says here that your SG&A expenses, you estimate that every cafe you open will start bringing in those costs in the year that you start constructing. So you'll notice here, the extra 900,000 starts coming through here in 2018 of SG&A expenses. The only thing that doesn't come through is your revenue. So all your expenses, your SG&A expenses and your rentals need to start coming through from the time in which you start constructing. You have to pay the employees. You've probably started hiring employees. You're already starting to market, doing a lot of the marketing costs. So all those costs are incurred, even though you haven't started bringing in some revenue. Your depreciation, remember, your stores are not constructed fully as yet. You cannot start depreciating until your cafes are ready to use. So at the point in which these stores are ready, which is the end of 2018, we will then start depreciating these stores from 2019 onwards, when they start also bringing in some revenue. Okay, so you'll notice in 2018 period, for your income statement, we've brought in just the 2 additional costs, which is your SG&A for the 3 stores. We've also brought in the rentals of 180,000 per cafe for the additional 3 stores, and we're now sitting at a loss of 40,000. Okay, going forward now, we're going to start adding as well the revenue, not just the SG&A expenses and the rental, but we're going to start adding the revenue, the gross profit that comes from that revenue, and we also will be adding your depreciation, because now the 3 initial stores from the previous year are now in full use, and you can start depreciating those additional 3 new stores. So you'll notice for 2019, 2020, 2021 going forward for the revenue calculation, what we do for that each year is we bring in your revenue stores. So you've got 13 stores are bringing in revenue, even though you've built in an additional 3. Remember, the other 3 are getting constructed in that year. So only 3 are brought in. 16 here are bringing in revenue, even though at the end of the year, you'll have 19 stores and so forth. Until 2020, when you've got 22 stores bringing in revenue, no new stores are built during that year, and your full number of cafes is sitting at 22. Okay, then we need to calculate the gross profit margin. All you're doing here in the gross profit margin calculation in this line is all you're bringing in is your sales less your cost of sales. Remember, your cost of sales needs to be taken into account. You need to take into account a gross profit margin that they've given you here at the top of 70% here. So you'll notice, if I want to do a double check that I've actually calculated the gross profit margin correctly, all I'll do here from 2018 onwards is calculate the gross profit as a percentage of sales. And in each year, you'll notice that that should then be 70%. Okay. Your SG&A expenses and your rentals, remember that you're not using the revenue stores here, which is coming through this line here at the top. You're using the total number of cafes, because as you build up those cafes, your SG&A expenses and your rentals will need to pull through the total number of stores and pull in each line of the SG&A expenses. So in 2019, you've got 16 new cafes because you've have 13 and you're building the additional 3. You multiply that by 300,000. Your rental, same exact thing that you're doing with the SG&A. You're bringing in the total number of stores, which is 16, because you're constructing the additional 3. 13 are in place. You multiply that by 180,000. Okay, so once you've set up quite your Excel quite nicely, this should be quite self-explanatory on how you actually calculate these SG&A expenses. All you're doing each year is pulling your SG&A expenses here from your table that you've created and your rental cost, and you're multiplying it, remember, by the number of cafes, because you start incurring the costs even if you're constructing those 3 additional stores in that year. Okay, the one that I now need to explain in detail in terms of the income statement is your depreciation. Remember, for 2017 and 2018, in 2018, even though we've constructed the 3 new stores that year, we haven't started depreciating because the stores are only ready and fully operational at the end of the fiscal year. So what's important to have read here in your question, it said construction for 2018 is on schedule and you will have 13 cafes, but they're only operational by the end of the fiscal financial year. So they're only ready to start using at the end of 2018. So your depreciation then needs to start kicking in from 2019 onwards. Okay, how we're going to set this up is we've got a fit out cost of 900,000 that we need to take into account. And your additional depreciation will be 10% of that 900,000 for those 3 stores that were built in the previous year. Each year you add that. The new year, you have 3 additional stores at the 10% of the 900,000, but it's an additional 3 new stores that were fully operational at the previous year. So I just want to show you how we set this up. I've created here what is called an asset register. And for your asset register here, it looks quite complicated, but all I'm trying to do here, if I hide this, is remember you've got the original cafes here, the 10 cafes. The 10 cafes, they're told you in your cost of your cafes. So if you look here on the left, these original cafes had cost you 8 million. And if you look here, you're also depreciating them at 10% per annum. So in 2016, you depreciated it by 800,000. In 2017, you'd also depreciated by another 800,000. So your original 10 stores are still getting depreciated. Don't forget about that depreciation. That still needs to be taken into account for the 10 original stores. Okay, every year the depreciation goes up and the depreciation is 800,000 each year, 800, 800, 800. Okay, your accumulated depreciation, all you're doing is the 800 plus the additional 800 to get you to the 1.6, plus an additional 800 to get you to 2.4, 3.2, and so forth. Okay, and then for the new cafes, so we've got 22 cafes over time over the next 4 years, 3 cafes each year. Remember, we are spending how much? We've spent 900,000 that year, but the depreciation only kicks in the following year when it's in use. 900,000 times 3 will give you the 2.7 million. At 10% will be 270,000 depreciation each year. Okay, same with the following year. You start building that year. It's not in use yet. Okay, it starts getting used in 2020. So your depreciation will then be, for those 3 stores, will be the 900,000 times 3, which is 2.7 million for 3 years. Okay, each time we do that for each of the stores, we stagger the year in which we started constructing. The following year, the depreciation kicks in. We stagger it for the year we started spending on the construction. The following year, this depreciation starts kicking in. Okay, and all we're doing here at the bottom is then calculating the annual depreciation. You're taking that 800,000 and then you're adding all these depreciation costs. In 2016, you'll remember, we actually didn't have any new stores in place or new cafes. Same with 2017. The new stores only started kicking in 2018. Okay, so in 2018, remember, we added 3 new stores at 2.7 million, but our depreciation in that year would have been nil because we only started depreciating the following year. So for that year, depreciation is only 800. From 2019 onwards, we start bringing in those additional stores. It's just 800 plus the 270,000. The following year, It's your 800,000 plus the 6 stores now that are being built, the first initial 3 and the second set of 3. 2021, the original 10 stores plus the 3 sets now of the 3 stores. And then lastly, in 2022, the original 800,000 plus the 4 sets of 3, which is the additional 12 store cafes that we've built, that will get you to a depreciation of 1.880. Okay, all these I can highlight now your depreciation, and you can now take this into account in your income statement. Okay, so what I do is I set up this asset register quite nicely. I then can now pull in my income statement the depreciation each year from that asset register. 800, 800, remember these 2 years stayed the same. The first 270 kicked in there. The 6 sets of 270 kicked in there, and so forth. Okay, then that's your depreciation. Okay, how are you going to set up the interest expense? You don't know how much of your facility you need at this point. That will be the number that you're going to try calculating your balance sheet. So for now, all you're going to get to is your PBIT or your EBIT, which is your earnings before interest and tax, or your profit before interest and tax. It doesn't matter what you call it. You calculate that, and you'll notice here in 2018 is where you've made a loss. But because in that year, the revenue hadn't started kicking in, even though you had started constructing some of those stores. Okay, your tax, what you're going to do for your tax calculation going all the way through is just multiply your PBT times your tax rate of 28%. Each time you just take the previous column's profit before tax and multiply it by 28%. Profit after tax, how do you do that calculation? It's just your profit before tax less your tax to get you profit after tax. So here where it says PAT and PBT, this represents profit before tax, and this is then just your profit after tax. Okay. For now, I'm going to leave out this interest calculation, but I'll show you how it's calculated, but you can leave a line for your interest as you do not know what the interest is yet. Okay, all I know for the interest is that I'll be required to pay an interest of 12% should I need that overdraft facility. At this point, you don't know if you need the overdraft facility because you don't know how much cash you're making, but I'm going to highlight that in yellow for now, together with that interest rate of 12%. Okay, now I'm going to be moving on to your balance sheet. Okay, your balance sheet. How do we then go and calculate your balance sheet? Your balance sheet, as you notice here in the question for 2016 and 2017 will have been provided. So you've got the full 2016 and 17 balance sheet, but now we need to forecast what will be our balance sheet for 2018, 19, 20, 21, 22. Okay. Your share capital, they wouldn't have told you anything about share capital in the question. So your share capital remains the same every single year. Okay. Your fixed assets, your fixed assets, so we'll talk about retained earnings just now. Your fixed assets, you've got the original costs of that 8 million that's flowed through from the 10 original cafes that we had opened up. And remember, we've got the new stores that kick in 2018. So even though you hadn't started depreciating them, you have incurred the costs related to that store and that cafe. So you start bringing in 3 times the 900,000 per cafe, and you bring it in here each and every single year till 2022. Okay, your accumulated depreciation, you take the previous year's accumulated depreciation and you add the depreciation that you brought in for that year. So how I do this calculation is I started off with 800, accumulated depreciation will then be this 800 plus this 800,000 here. Okay, the 2.4 will be the previous 1.6 plus the 800 there. So each time, if you want to do the calculation, I can show you here in detail. It's just the previous accumulated depreciation plus the depreciation for that year. Okay, so each calculation is quite simply the previous year's depreciation plus that year's depreciation. Okay, and you can keep doing that and just drag it across. Okay, and that's how you get to that accumulated depreciation. Okay, now I'm going to be moving on to current assets and current liabilities. This is where it proves a little bit tricky for some people because they don't know how to use those days calculation to calculate what the inventory balance is, what the debtors balance is, what the cash balance is, and then what the creditors balance is. To start off with the easy one is the cash balance. So you would notice here in the question and here at the top when you've got your summary, they told you that your cash balance needs to be 2% of what your sales were. Okay, so we go down to our cash balance here in our balance sheet. It needs to be 2% of sales. So all I'm going to do here for each of the cash, I'll show you how to calculate it here at the bottom. Give me a second. Your cash is simply just for 2016 and 17, you would have copied it across from here, your cash balance. But from 2018, it's just your 2% multiplied by your sales balance each year. Okay, and what's quite nice, that's where you get the 200. What could be quite nice is you guys can hard code. So you can actually use this figure from up here that you've now noted down. I function F4, I just hard code it. You'll notice when it's hard coded, it will look like this with the dollar signs. And each year, I'm going to bring in 2% of the sales figure, and I'm going to drag that across times, sorry, the revenue. The revenue, okay, it will be the 200,000, and I just drag that across. Okay, exactly the same as what we've got here in the calculation. Okay, and the calculation is actually showing you, you're taking each time your sales, and you're taking the 2% each year. Okay, that is how you calculate the cash balance. Cash, quite easy to calculate. All they've told you is that it's 2% of your sales. Okay, now we need to calculate what our debtors and what our inventory balance is. Okay, our debtors, if we go back to the question, I want to highlight here that it says 25 days of inventory, so I'm going to highlight that in red. 45 days credit from suppliers, creditors, and then we've got 30 days of our business accounts, but those only make up 20% of cash sales. So I'm going to highlight that in red. Okay, remember, I had actually laid this out quite nicely here at the top at the beginning. So here, I put our credit sales 20%, debtors days were 30, creditors days were 45, stock days were 45. Okay, where do we typically get our debtors days from? Okay, so if it says our credit sales portion is 20% of what? Okay, when people actually come and take stuff from your cafe and purchase from your cafe, these debtors, they are actually purchasing and giving you a portion of your revenue. So what debtors typically do, your debtors balance usually is pulling from a revenue balance but it represents the credit portion of that revenue that you've earned. So whenever I'm thinking of which two accounts link together, when I think of debtors days, I immediately need to think of revenue. It ties together with my revenue. Okay, I've made a certain percentage of sales that year. Some of it was cash, some of it was credit, my entire revenue. But when they're saying debtors days, you've allowed some people to take stuff on credit, it relates to the revenue portion that you've allowed for people to take on credit. Debtors talks to your revenue. Okay, what does my creditors days talk to? Remember in the question here on the left, it says it's 45 days credit terms from your suppliers. Okay, if you are working with creditors days from your suppliers, then what it means is your creditors days needs to talk together with the people that are supplying your goods and services. Okay, so here at the bottom, when you're calculating your creditors days, it needs to talk to the people that are supplying you with your goods and services. So your creditors days here ties together, and not with the revenue account, but your cost of sales. Your stock days, as well as and when you sell the stock and it comes out of your business, it then becomes your cost of sales that you're using to calculate your revenue figure for your gross profit. So initially, when you buy a lot of stock for these cafes, they come in through inventory, but the minute someone goes and takes a good and it becomes revenue, it becomes also a cost of sale. Okay, so your stock days, when it leaves the inventory and it no longer becomes inventory, it becomes a cost of sale that you've then sold on to your customer. So the account that your stock days goes with is cost of sales. Okay, this is important. For your working capital, my debtors needs to talk to a percentage of my revenue. My creditors days and my stock days both use the cost of sales as a driver, as to indicate how many days are my creditor days as a percentage of the cost of sales. My stock days also, as the stock comes out of my business, it becomes a cost of sale that I've then sold on to the customer. Okay, so how do we then calculate these balances related to your debtors? How do you calculate inventory? And how do I calculate this creditors balance? Okay, I'm going to show you now. I'm going to put in here a line item in between debtors and inventory just to show you how I do the calculation, and just before the creditors, just so you can follow through how I've actually done the calculation. It says for debtors days, if you read carefully, that your debtors days are firstly, your credit sales portion is 20% of your revenue. So the first thing we're going to do is take 20% of this revenue. Remember, we had already noted the 20% up there at the top, and I can just use that figure up there from the top, which is my Excel spreadsheet that I had created. So what I want to do is bring in this 20% up here, hard-coded. How you hard-code is function F4, or just F4. I multiply that by the sales. Remember, it ties in with your revenue. And then they said it's 30 days. So you're going to bring in the 30 days up here, and then you divide that by the 365. Okay, that's how you get to the 164,384. That's the calculation. Okay, let me do it again just to show you. You're taking the 20%, the credit sales portion, function F4, multiplied by your revenue for that period. So now I'm doing 2019. I close the bracket. Then the days that they told you in the year is the 30 days divided by the 365. Okay, and each time you do that exact same calculation, 30 days of the 20% of revenue, you'll get to all the debtors days calculation. Okay, then I'm going to remove this. That's how I've showed you how to do the calculation. Then let's look at how we do the inventory calculation. Your inventory calculation is equals to your cost of sales. And now they've told you your inventory days are equal. You take your stock days, or what is called inventory days here, 25 divided by the 365, and you close the bracket. You should get to that 205,479. Okay, let me do it again just to show you the inventory days calculation. You take the cost of sales multiplied by your stock days divided by 365. Okay, each time you will get to that answer there that I've shown you how to do it. But if you are struggling to follow through, just look at the formulas. I will be posting this onto the dashboard so that you can make use of it. Just have a look at that formula and it will show you how the inventory days are calculated. Okay, we had already done cash. That was the easier one to do. Then last but not least, we've got the creditors days. So your creditors days, we're going to take also the cost of sales. Remember, I said it's linked to the cost of sales account multiplied by, now you trying to search for your creditor days, that divided by 365. Okay, I'll do that one again as well. Cost of sales, it links to your cost of sales account multiplied by the days they told you. I'm going to go try to find the days for creditors days, 45 divided by 365. Okay, exactly the same each time you're doing that. You're just taking the days divided by 365. That will give you what the balance is of each of those accounts. Okay, I'm going to remove this. I was just showing you how to do the calculation. Okay, so now we've completed the income statement besides the interest account, and we've also now completed the balance sheet. And the only thing we left with in the balance sheet is determining whether the company needs an overdraft based on the balance sheet items we're seeing. Okay, so your balance sheet will tell you, did you need to take in an overdraft? Your overdraft will be then the balancing figure that you'll be using. Okay, but now we still haven't calculated two accounts. So we haven't calculated, I haven't shown you how to calculate here, your retained earnings. Okay, which I'm going to highlight here in blue. And then I haven't shown you how to calculate then this overdraft. And your overdraft will then just be the balancing figure. Let's see how we calculate these last two that are then required to finalize this balance sheet. And also now that I've got the overdraft, I can then also work back what the interest calculation is. It's basically a long way of doing it, but you needed your interest to calculate what your overdraft would, you needed your overdraft to calculate what your interest would be, but you also needed your retained earnings. And what is retained earnings? It's an accumulation each year of the profit that you're getting from each of the years. Okay, so all those three accounts at the end, I'm trying to just balance and see how they're all working together. Okay, the retained earnings for 2016 and 17 was provided to you. So what you're going to do here for 2018, okay, in that year, you've made a loss of 40,000. So in that year, what you're going to do is you're going to take the previous retained earnings and add the loss of 40,000, okay? Your retained earnings, what it reflects is I've got earnings that have been accumulating over time. So what I want to do is I want to take the last year's retained earnings and add either the profit for this year or the loss for this year. Each year, it's the same as accumulated depreciation. You take the balance before and you add the depreciation that year. The balance for the year before and add the depreciation that year. So your retained earnings is also an accumulation of either your profits or your losses. So you need to take the balance before in the year before and add the profit that year. The balance in the year before, add that profit that year. So you'll notice what I'm going to do here for your retained earnings calculation, which I'm going to set up here. I'm going to pull through each year the previous year's retained earnings balance, and I'm going to add the profit for that year. Each year, that profit is going to have to come through. Okay? So in that year, you decided to pay a dividend. We'll see what dividend you decided to pay. So it should have been 338. I drag that across. Let's do the following year. So previous year's depreciation, retained earnings, plus the profit for that year. Okay, we do it again. Retained earnings plus then your profit for that year. Okay. And then we drag that across. Okay. For your interest calculation here, this needs to pull through from your overdraft. Okay. So what we're going to do, we should have already set up here in your income statement that there's an interest element here that you needed to pay. The interest element will relate to what this plug is here. So firstly, you set it up that the interest I need to pay is based on what my overdraft here should be. How do I get to this overdraft figure? I need to try and balance out what my balance sheet is. Okay, so if I look in total, if I add up my retained earnings for 2018, how much capital did I have in full? So for my share capital, my investors, together with all the profits accumulation that I've earned, let me remove this line because it's a duplicate. You've got around 6.3 million rand. You spent 8 million on fixed assets and around 5 million. There's no ways you could have spent almost 8 plus 3, 8.8 million rand, okay, and only had capital of 6 million in terms of what you're sitting with in your balance sheet. So what do we mean by the plug number there where we put overdraft there? We're saying that in order for you to have bought those assets to get it to 8.3 million and your current assets, you needed to have gotten some other facility to supplement that capital cost of 6.3 million. So how do I calculate this overdraft plug figure? I need to add up all my assets, okay, subtract what costs I had to see my capital that I had and the creditors, to see what is the balancing portion that I needed to finance the remaining of those assets. Okay, how did I do that? I'll do that again to show you. I bought assets in 2019 worth 9.9 and worth 740,000. Okay, more than almost 10 million. I only had 6.4 million in terms of my share capital and my retained earnings. And then also my suppliers had given me a credits facility of 480. So I must have needed an additional, how much? 3.7. Okay, so all I'm doing, if you'll notice, I'm adding your assets. I subtract what capital you had in the business. Okay, add your assets, subtract what capital you had in the business. Your capital that you had in the business is all your profits accumulation and your share capital that the guys had invested in upfront. Okay, then that will give you what your plug number is, which is what your overdraft that you needed. Okay, each year you do that. I'm going to show you it one more time with the 2020, your fixed assets plus your current assets, subtract what I had here in retained earnings and share capital and what my suppliers gave me. I needed an additional 495. That is how you calculate your overdraft plug figure. Okay, so now I've shown you how to do your retained earnings and I've shown you how to do your overdraft plug figure. But now your interest then needs to be, the interest you need to pay, your loan is 0. You need to pay now interest on this overdraft facility. They told me that my interest at the beginning, you'll notice, was 12%. And now you're pulling the 12% multiplied by that overdraft for the following year. So you'll notice I took out this overdraft at the end of the year. So the interest that I then need to pay is for the next year. Okay, my interest will be 12% of the previous year's overdraft. The following year, 12% of the previous year's overdraft. Okay, if you notice here, what it says here in the question, it says you have a line of credit at a bank that allows you to borrow up to 10 million at an interest rate of 12%. So that is the 12% that I'm then paying. It's the 12% of the previous overdraft. Okay, then this is included as part of your profit after tax. Don't forget to include it. And then your retained earnings needs to pull each year from that. So your interest is needed for your profit, which is needed for your retained earnings, but your retained earnings was also needed for your overdraft. It gets a little bit confusing and you're like, okay, where do I start? What I'd suggest you do is you can set up your interest here initially to just pull a blank figure here. You don't initially know what this overdraft is. So you just pull the 12% of this amount, whatever this amount will be, okay? And then you drag that across and you calculate what your profit after tax is. Your retained earnings, you're gonna still pull this figure each time, okay? Then your overdraft will just be the amount of assets less your total capital, and that will then be the plug figure that you'll be using. Okay, it's quite a complicated way of thinking about it, but if you work through these Excel numbers, it should make sense because your interest needs to pull from the overdraft, but the overdraft is the balancing figure that you first need to calculate in your balance sheet. Okay, I've tried to take you now through the income statement and through the balance sheet. If you do have any questions, please make sure to email me. I'm happy to answer any questions on the income statement and the balance sheet. What I will try and do in class is explain once again how you calculate those current assets and current liabilities for your working capital calculation. But I'm going to leave it there. It's been quite a long session to do in a video. So I've taken you through sort of your case study together with the income statement and together with the balance sheet. And what we'll be looking at in the next session that I'm going to be recording is how you then look at your valuation and your capital budget. So once you've actually set up your income statement and you've set up your balance sheet, you then need to now pull your cash flow items, remember, to then calculate what the valuation then of the business is and set up your capital budget. Your capital budget will have each year 2018, 19, 20, 22, and you'll try and value now those cash flows going forward, but we'll cover that in the next session. Thanks, guys.